Hi everyone. So there is something very interesting that is happening in the market, and let me share two reference points to illustrate that point. Now, first reference point, you can see from here that this news is roughly a week back, and it was being speculated that Mr. Warren Buffett is going to invest in bonds. Bonds matlab debt khareed lena. For example, when you and I do FD investments or invest in government bonds, that is called as bond investing. So a lot of speculation was being made that Mr. Buffett, he's an equity guy. Why would he put so much money in bonds? Is he not seeing enough opportunities, vagera, vagera? And then recently the news came, and this is literally 24 hours back. And now a decision has been reached that Mr. Buffett is going to buy a lot of bonds, right? Now, why is Mr. Buffett buying bonds all of a sudden? Why is he cutting his position on one of his key stocks with his Chevron? To do all this, he has been using a strategy called as barbell strategy. Now, this is the same strategy that he uses in order to design his wife's portfolio, and he's using the same strategy to design Berkshire Hathaway's portfolio. So why is he doing it, and how you can apply this barbell strategy as per today's market circumstances in India? For making these type of videos, I have to study a lot. In fact, I have an exam on 16th, which I'm going to write. I'm not going to reveal which exam it is. Jab ho jayega clear, then I will tell you. But I study a lot in order to create these type of videos. Little bit of support from all of you would mean a lot. So if you can just press the like button. I know that you haven't done it. So please press the like button and wish me best of luck for my exam. And let's get started. This is going to be slightly nerdy topic, but you will learn something very, very interesting, something very new. And this will definitely help you build a better, more realistic portfolio by picking some of the learnings of the recent moves that has been made by Mr. Warren Buffett. So let us break apart the video, and also a very big shout out to our sponsors for today, which is Incred Money. They are an excellent bond investing platform. उनके प्लेटफॉर्म पे जाके you can go and check out the bonds that are listed there and invest in it. More about them subsequently on the video. So let's get started, and let's first and foremost understand why is it that Mr. Warren Buffett is buying bonds all of a sudden, and why is he cutting his position on Chevron. So there are three big moves that he has made, and I will reflect these one by one and give you some explanation around it. So number one key fundamental change, he is buying bonds, and as a chota mota nahi, he is buying a lot of bonds. For example, Berkshire was sitting on a cash pile of $157 billion, right? Now out of that, and recent move has been that only $50 billion is in cash. Rest almost $100 billion have been put in bonds. Now, why will Mr. Warren Buffett invest in bonds all of a sudden? So there are two specific reasons for that. So the first key reason is the US interest rate. And when I say US interest rate, even India's interest rate, जो prime lending rate होते हैं, they also move as per the US dynamics, and even the world's interest rate also moves as per the US dynamics. So whatever is happening in the US, since the fact is that the world is so interconnected, anything that is happening in the US financial markets there, it's going to impact India also. So this discussion is relevant for Indian markets as well. So anyways, first reason why Mr. Buffett is buying bonds is very, very simple, that right now the interest rates in the US are peaking. Now, what does interest rate peaking means? It means that Mr. Buffett himself now considers that, see, going forward, interest rates are going to cut. So what he's trying to do is that he's buying bonds with less than 2-year maturity, right? And he's thinking, yaar dekho, I will at least lock in my safe capital in these type of bonds as of now. And then I will make a choice what to do next, right? Whatever money I had to put in my growth portfolio, I have already put it. So safe portfolio, whatever I need to create, I'm going to lock it because interest rates right now are really, really good. Now, even in India, you would have observed that when it comes to FD investing, that HDFC Bank FD, ICICI, and all these different banks FDs are offering very, very good rates. So should we also book some FDs and all that stuff? The short answer is yes, that you should lock in some bit of your capital, safe capital, like Mr. Warren Buffett in these instruments. Now, the second reason why he is going to bonds and not equities is very, very simple, that right now he does not see too many bulk buying opportunities. Now, what is the meaning of bulk buying opportunities? Please go and check this video of mine where I had shown a Nifty swing of live investing like 50 lakh rupees in Nifty. At that point in time, Nifty was trading somewhere around 17,500 when I took this big position in the market. That was a very clear buyer's market that you should have purchased in bulk. भर भर के खरीद लो वाली चीज. But now the situation is such that there is a very clear volatility in the market, and if you have already purchased stuff, majority of your stuff at this level, then what you are looking for is a very clear telltale sign कि अच्छा ठीक है, this is where the markets are going to consolidate. Now, it might happen that markets might consolidate at 18,600 level. Now, why am I saying 18,600 level? So if you actually zoom the Nifty 50 chart, and if I show it to you here, so this range that you're seeing here, this is around 18,600 level, right? So this is where the markets are moving from here to here. So this is a major support point. Now, what can happen is that the markets might consolidate here in this zone only, or they might give a breakout and then consolidate up. Now, if someone has already built position somewhere around like, let's say 15,000 to 17,000 range, for them investing has mostly been done, right? So they don't need to risk more of their money in equities. They are being safe, sound, now let me just fill out my safe portfolio. And then once there is more clarity on the markets, then we are going to build more positions. Now, this is not a recommendation from my side or the data that I'm interpreting for Mr. Warren Buffett, that this is not a recommendation even from him that you stop equity investing. Growth money, if you have already invested, then invest some of your safe money, lock it in. Why is now a great time to do all these fixed deposit, bonds, vagera, vagera? Very simple, that as I went to reason number one, that interest rates have peaked and going forward, they are going to cut. So the returns that you're going to make by doing bond investing, etc., those returns are going to come down because these interest rates itself are going to come down. So I hope that this first part of the story is clear, that why Mr. Warren Buffett is building his position on bonds. It's very simple, that he is fixing his safe money portfolio. It's not as if that he has lost trust on equity, that he'll not buy equity, all that stuff, or Akshat is not buying equity. I think all equity investors are going to continue to buy equity, but at the same time, you need to be sensible in terms of fixing your safe portfolio. So on that note, if you're looking to make some bond investments, then definitely go and check out Incred platform. They are running a Diwali offer where more yield will be offered for specific bonds. So there is additional up to 1% yield. I will link all those different bonds which I found to be really good in the description and comment box. Check out that link. You yourself will be able to use the platform, scout the bonds as per your risk appetite, and wherever you deem fit, that whatever bond you see fit as per your understanding, as per your risk profile, you could consider investing some money there. Now let me very quickly speak about two more updates on Mr. Warren Buffett's portfolio. The second key update is regarding Chevron. So Chevron is an oil and gas company. And what is oil and gas? Oil and gas is a commodity. Now Mr. Warren Buffett has cut his position on Chevron. Now I think, and I'll have to double check the dates, I think he purchased Chevron somewhere here and he has already made his profit and he has exited, or now he is exiting Chevron or is cutting significant position on it. Now why is that? Because see, the commodities market is now stagnating. For example, today Steel Authority of India Limited was downgraded and there was a good correction on the stock on sale also. Now what is sale? Sale is steel commodity stock. What is Chevron? Chevron is oil and gas commodity in a way. So all the commodity stocks, it looks to me that these are stagnating. They are unlikely to be major contributors when it comes to a growth market, that as the market in India moves from that 19,500 level all the way till 21,500 level, I do not think that much contribution is going to come from commodities. So on that note, Mr. Warren Buffett is cutting his position. I'm just revealing it. So in case you have some commodity stocks, you can think about what you need to do there. So now comes the third key update, that Mr. Warren Buffett is doing buybacks. Buybacks of what? So they run a company called as Berkshire Hathaway, which is a type of an asset management company that they go and buy other companies. It acts as a private equity player and they make their own management sit there and they improve the operational efficiency, unlock value, and then sometimes sell it or sometimes run the companies. So they are collecting assets which are a portfolio of different companies. Now basically, usually what happens is that whenever the stock price is down, Mr. Buffett and Mr. Munger, they end up purchasing the stocks of Berkshire Hathaway, which is the parent group company. Now, what has typically happened is that Berkshire Hathaway only purchased $1.1 billion of stock in a last quarter, that in 3 months, they had only purchased $1.1 billion. But recently, Mr. Buffett and Munger seem to have bought back another 800 million in the last quarter and October 24th. So basically, they have ramped up their buying on Berkshire Hathaway itself. Now, what does this indicate? Number one, it indicates that, you know what, the stock is available for cheap, and if the company is getting to buy it, so be it. So khareed lete hain, right? And because we are getting it at a good price and we expect the stock to go back up quite aggressively. So it is a value buy, and this is the type of investing that Mr. Munger and Mr. Buffett have usually done. So this is reason one. Reason two is, you know what, when the stock typically falls, sometimes the owners come in or promoters come in and then they end up buying the stocks just to prevent it from the fall. So these are two possible reasons, but this is not working out. This is the reason why they are buying the stock as of now. Because why? Because again, if you check that previous article, the stock has already rallied by 13%. So this is not like a Dani-like situation that the stock is falling and the promoter has to come and support the stock and all that stuff. No, nothing. The stock was already doing well, and in that mode, they have gone ahead and bought even more. Why? Because they see value in the stock, is seen as a valuable player. What does that mean? So probably the industry is going to benefit. Now, which industry does Berkshire Hathaway operate in? Well, it operates in finance, and 70% of my portfolio is in finance or in some form of finance. So therefore, I am also bullish on finance stocks. So these were 3 critical updates from Mr. Warren Buffett's portfolio. So I hope that you got good clarity. Now comes the second critical concept, which is around barbell investing or barbell methodology of investing. Now, what exactly is barbell methodology of investing? This is used by Mr. Warren Buffett, and this is typically used in the bond market, but a combination of bond and equities can be done in order to design this strategy. So let me first and foremost share an interesting article about Mr. Buffett using this barbell investing strategy for his wife and designing her portfolio. So he says that Buffett's barbell is 90% equities and 10% cash for his wife and Berkshire and maybe retirees. So what exactly is this strategy? So he's saying that, you know what, Mr. Buffett is using 90% of his money to invest in S&P funds. So this is equivalent to Nifty 50, right, in India, and 10% in short-term treasuries. So short-term treasury ho gayi, jaise for example, in India, we have T-bills, T-bonds and all that stuff, which is secure credit. So in India, if you don't want to do bond investing, you can go and put your money in FDs. That also serves the exact same purpose. The only difference between FDs and investing directly in bonds is that you get better yield on bonds compared to FDs, because उसमें बैंक से commission हो जाता है in FDs, so that is the problem there. So this is what an oversimplified version of barbell investing is. अब barbell exactly होता है क्या, right? For example, if you go to a gym, and I will put a better picture because my drawing is horrible. So this is what a barbell looks like, right? ये weightlifting वगैरह के लिए use होता है. And here basically what you are trying to do is that you are trying to create 2 halves of your portfolio, right? One is called as risky and other is low risk, right? So these are the 2 parts of your portfolio that you are trying to create, and you keep on buying certain types of assets. For example, यहाँ पे you will buy asset 1, 2, 3 which are low risk, and here you will buy asset 4, 5, 6 which are slightly higher risk. Now typically it is seen that equities are higher risk. Now, is entire equity segment higher risk? The short answer is no, the entire segment is not. For example, for Mr. Warren Buffett's wife, Mr. Warren Buffett has picked S&P 500, which is relatively low risk or possibly the lowest risk asset when it comes to equities, right? So that is an asset that he's picking here, which is point number 4. Now for him, he might be picking stocks directly, right? So these are slightly more higher risk asset, which could be individual, direct, large cap stocks. Then he might pick some small cap stocks also. So this part of the barbell becomes risky. The other half of the barbell is kind of safe-ish. So here you will pick what? Here you will pick short-term bonds. Here you will pick FDs. Here you will pick long-term bonds. Now people typically say that, you know what, you need to have like a 60-40 allocation. And this is a proposed allocation that 60% of your money should go to low risk and 40% should go to slightly more risky assets. Now this really depends on the type of market where you are doing investing. Now think about it this way, that in India, the equity markets are likely to perform better compared to the American markets, especially given current circumstances. Why? Because the cut on our interest rate need not be managed that much. Inflation problem in India is not that much compared to the US. We have higher growth rate compared to US economy. There are avenues for growth. For example, FMCG market, if you look at hospitals, if you look at banks, there are areas for growth in Indian economy. But when it comes to American economy, are there areas for growth? Yes, might be, but the growth rate might be a mismatch compared to India. So from that perspective, this 60-40 needs to be contextualized. And towards the end of the video, I will give my viewpoint on what this split in India should be for moderate, defense, aggressive type of investors. But I hope you got the concept of what barbell means. Now, the typical way this barbell strategy is designed is ki ye rahi aapki barbell, these are your weights. This is designed entirely in the bond market also. That some people say that, you know what, equity is very, very risky, so I will not go there. I will just stick to bonds. Ye thoda purane zamane type ka ho gaya, right? And this is highly academic from that perspective. Now, typically, previously what used to happen was that bond was considered to be extremely safe and equities were considered to be highly risky. But unfortunately, you might have seen that there was something called as yield curve inversion, and some banks that had purchased US long-term treasury bonds, they went under. Bhai, unne to bond kharide the na. They had purchased and made their barbell strategy here. they went bankrupt, right? And during that same time, equity portfolio of people did fairly okay. So what I'm trying to tell you is that if you go and read books, usme to academically they will just tell you कि अच्छा barbell strategy you have to make, go and make it in bonds. But a better way or a more nuanced way in 2023 is to mix bond with equities in order to create this barbell strategy. Now let me break it down that how you can create this barbell strategy as per aggressive, defense, moderate investor in the Indian context. So in the Indian context, if you're trying to create this barbell strategy, you can't go with the option of going entirely to the bond market only. Now, why is that the case? The reason is very simple that in India, the bond market is not at that level of maturity. New bonds are coming up. This market will become more prominent with time. Good stuff happening in this market. Yes, the market is maturing and you should definitely consider building more positions, but this market is going to evolve. ऐसा नहीं कि इसमें कुछ problem होगी. But bottom line is that more options will be added in this market as we progress. Second key reason is that, as I explained earlier, that the equity market, which is the risky component of this barbell, in India that is likely to do much better. Because in India, the inflation or stated inflation is 5 to 6%, and India's cost of capital for average corporates is somewhere around 7 to 8%. So if you add both these numbers, it comes out to be between 12 to 14-15% growth. So this growth is likely to happen in the equity market. So you can't miss that, right? That's the important part. So even if you are an ultra conservative investor, the best thing that you should do is go 50-50, right? So this is for conservative people who do not want to lose money. You should still do 50-50 as per my understanding. If you're aggressive, someone like me, then I would do something like 80-20. And if you're moderate, then you can play around with this number. So anyways, quickly wrapping up 4-5 key things. See, on the non-risky side in India, you can definitely do a mix of fixed deposit, short-term bonds, long-term bonds. Now here you have corporate bonds, here you have government bonds, here you have corporate bonds, here you have government bonds. Now, right now the situation is that the short-term bond market is doing better than long-term bonds, right? So if you are going and locking your money for 2 to 3 year period, that is typically considered as short-term, these type of bonds are likely to do better. Long-term bonds may, unless the yield curve is re-inverted. Now, what is the meaning of yield curve getting re-inverted? I'll explain that in a minute. But structurally, long-term bonds are not doing that well. So let me quickly explain what is the re-inversion of the yield curve. So if you take a look at this chart, what you will see is that this is the difference between 10-year yield minus 2-year yield. Now, typically what happens is that long-term maturity bonds, जैसे आप लंबे टाइम के लिए FD कराओगे, right? If you do it for longer term, you will expect, yeah, you know what, I need like 10% return or something. But if you're doing it only for 6 months or 1 year or 2 year, then okay, fine, I'll take like 7% also. So therefore, the difference between this 10-year and 2-year should be positive, typically speaking, right? And you can see that this was the case all the way till here, right? And if you look at the previous data also, and let me zoom it and show it to you. So you will see that this data is from 94 and mostly it is what? It is positive, right? This difference. Now what has started to happen is, and let me go back to my previous chart, what I was trying to show you, and you will see that right now there is a good opportunity in short-term bonds compared to long-term. Once this thing comes back up and it started to go up under normal circumstances, then long-term bonds are likely to do better compared to short-term. And therefore, one of the reasons why Mr. Buffett is investing in bonds is in short-term bonds, where the maturity is less than 3 years, right? So this is the entire viewpoint that you need to understand on the non-risky side. So see, the lowest risk instrument that you can pick in India is Nifty 50. This is likely to go at 12% from here, right? वो तो last 20 years the CAGR has been this. Please note that you need to give Nifty at least 3 years. Whatever money you are putting today, please do not start monitoring it for tomorrow. Please give it 3 years. If you need that money, then you cannot put your money in the risky component. You have to go to bond market only. Second key thing is that in India or a growth economy like India, your barbell should include something like small and mid cap also. If you don't want to buy individual stocks in small mid cap category, completely cool, not a problem. Buy index directly, that's not an issue. Now here, if you are very uncomfortable seeing your portfolio fall down, all that stuff, then keep exposure limited, but have some component to it, because typically it is seen that this part of the value chain typically on a 3 to 5 year basis, it gives you more than 20% returns, right? So this is very, very important. Right now, a great opportunity in large cap. Please go and check my previous video. I had spoken about why I'm building more position in pharma, why I'm building more position in hospital stocks, and bunch of other indicators I have given. I will also write a detailed member community post tomorrow on the same topic. But the point is that right now, large cap risk is also less and valuations are also very attractive. This rarely happens, or very seldomly it happens in the Indian market. So this is a good asset to add on your risky side of things. Then finally comes some of the growth industries. For example, by analyzing Mr. Buffett's portfolio, it is clear that he's cutting his commodity stocks. Why? Because he does not see growth in that industry. So similarly, if you are sitting on loss of 5%, 10%, 20%, whatever percent that loss is, there is no harm in cutting positions in industries where you do not see growth coming. Just because you're sitting on 10, 20% loss and not cutting your bad stocks, it will be a bad move. So I hope that this brief discussion was insightful for you and it would allow you to plan your portfolio. In case you're interested in learning more about my portfolio, how I have designed it, here is a more detailed video. You can go and check it out, where I have revealed my profit and loss statement also and how much money I've been making in the last 3 years of my stock investing journey. I hope you liked it and I will see you soon.